When the Dodd-Frank bill was signed in 2010 in the wake of the global financial crisis, it was meant to prevent Wall Street from taking excessive risks. A key tenet was the so-called Volcker Rule, which limits proprietary trading, banks using depositors' money to make speculative investments. The former head of the U.S. Federal Reserve, Paul Volcker, believes these bets were a key factor in the collapse.
10 years after U.S. banks got a $475 billion taxpayer-funded bailout, the Trump administration now wants to water down the Volcker Rule.
The 6 largest banks in the U.S. have lobbied for change. They say the rule is too complex and want it simplified. Proposed changes include giving the banks more leeway in determining what constitutes a proprietary trade. The burden of proof will also shift from the banks to the Federal Reserve. Regulators say the initial intent of the rule will remain intact, but consumer advocates are alarmed. Columbia University law professor John Coffey says the changes are not worrisome if banks comply with the new rules and regulators enforce them.
If there was strong verification, if there really is monitoring of compliance, then I don't think this will be something that opens us up to a new financial crisis.
He says the bigger concern is the anti-regulatory mood in the White House and the Federal Reserve's proposal to chip away at evaluations of a bank's strength called stress test.
All those stress tests did a great deal of good. They told us where there were real weaknesses. Once you do a lot less stress testing, I think we'll see greater risky activities occurring in many banks.
The U.S. public has 60 days to comment on the proposed changes to the Volcker Rule. In that time, a lot can change. Karina, CGTN, New York.